Okay, guys, we're going to go ahead and start the lecture for Chapter 11. My apologies for having to cancel class from Monday. Sometimes family issues call, so I appreciate your patience. But I wanted to go ahead and do this lecture, and I'm providing this for you, hopefully to help you with your final. I think some of you maybe have already taken the final. But I do think some of the information I'm going to give you here will be helpful for those that are waiting to see this before you attempt the final. The final is due Monday night, 11:59. Okay, and it'll cover Chapter 6, Chapter 11, with quite a few questions from Chapter 11. So that's why I extended the time for the closing of the final on iLearn so that you get a chance to potentially look at this video before you attempt the questions on the final, which is quite a few from Chapter 11, quite a few questions there. Okay, so let's just go ahead and we're going to focus on a couple of different things in this chapter. Foreign currency transactions, and also what happens if we have a foreign subsidiary and we want to consolidate. We'll assume U.S. parent, foreign subsidiary, say an English subsidiary, that they want to consolidate those financial statements into the financial statements of the parent. So it kind of completes our discussion a little bit more of the consolidation process, and that you could have a foreign subsidiary whose financial statements are denominated in, say, the pound, and we want to consolidate them into the U.S. parents whose financial statements are being reported in dollars. We would first have to, and we would either remeasure or translate the foreign subsidiary's financial statements from, say, pounds, again, I'm going to use pounds as my example, to dollars, and then we could complete the consolidation process the way we've talked about in some of the other chapters. The other area is foreign currency transactions, and we're going to talk about that first. And this is really contemplating a situation where we have, say, an unrelated business entities, and we order, I don't know, cookies from a company in Mexico. We're a cookie seller in the U.S. We have all kinds of different types of cookies that we have from all over the world. And there's a Mexican cookie maker that we want to, offer our customers Mexican cookies. Well, we have to acquire that inventory from the Mexican company, and so they expect us to pay them in pesos. So we want to understand, well, how would we account for that transaction, which is denominated in a foreign currency, in this example, pesos, and then having that be properly denominated in our financial statements in dollars. And we're going to see that when that happens, when we have a transaction, again, this is not between related companies, this is just buying, say, inventory from a foreign entity that expects to be paid in their country's denominations. There's going to be a foreign currency transaction gain or loss that will be reported on the income statement. And so we'll take a look to see how that's talked about here in the slides. And then a little bit later, when I go through the quiz practice final with you, you'll see how we're going to be testing that on the real final. Assuming you haven't taken that yet, you'll then kind of see how those questions on the practice final are similar to those in the actual final. Okay, so with that, let's just go ahead and talk about generally foreign currency. And again, as I've mentioned, foreign currency transactions we're going to talk about first, and then later we will talk about foreign currency translation is one method. The other method that we will talk about, depending on the nature of the relationship, will be remeasurement. Okay, so we're going to have those two different possibilities. We're going to have translation or remeasurement, and this is when we have a foreign subsidiary and we want to consolidate them into the U.S. parent, we want to use one or two processes, either translation or remeasurement. And it really depends on the nature of the entity that we are dealing with. Okay, we'll see that as we go along a little bit later. Okay, but let's talk about foreign currency transactions first, and we can see that this is the situation where we have a U.S. company, and it's going to have sales, purchases, other transactions, giving rise to a transfer of foreign currency, or the recording receivables or payables that are denominated in a foreign currency. So we're looking at a transaction at a time here. And it's contemplated in these situations is that you really have two unrelated entities. Now, if we're talking about the consolidation of a foreign parent into the U.S. financial statements, then of course we will be using either the translation or the remeasurement, as I've talked about earlier. Okay, so they say translated, but we could also be using something called remeasurement. Okay, I'm just going to fight with the colors on my pen here a little bit. Okay, and we'll talk more about that later. Okay, goods, that's a T. Okay, so let's just go over though, and let's try to focus on the foreign currency exchange rates. And they are established daily, okay, by different sort of brokers. And there could be some set rates, but usually these will fluctuate on a daily basis. Okay, and you can see some of the different factors that will affect fluctuations, interest rates, etc. Stability and process of governance. In other words, politics, and we've been seeing some of that in the news with some of the tariffs and discussions along those lines. All of these things could affect exchange rates. And you can see the various exchange rates between the US dollar and various types of currencies. And note, guys, that these change daily. I guess, okay, this was May 4th, for example, right here. Okay, so these change daily. And sometimes I'll have students will say, you mean we have to memorize exchange rates? No. Okay, we will give you exchange rates and questions, etc., that are assumed or contemplated in a question, and you just need to know how to use these rates. And we're going to look at some examples, and you'll see it's pretty easy. Okay, now you will see sometimes a definition or the question, whatever that we're looking at, will call out a spot rate versus the current rate. Okay, spot rate would be the rate at the time of the transaction for immediate delivery of currencies. Okay, when we get to year end, we're going to see that we're going to be having to make some adjustments for changes between the rate at the time of the transaction and year end, assuming that transaction hasn't been settled yet. And then we start calling out current rate. And all the current rate is the spot rate essentially at December 31st or whatever the balance sheet date is. I'll just assume December 31st there. Okay, so very similar. It's just that we start calling the spot rate the current rate if we're talking about calling it out as a specific balance sheet date. And most of the examples we'll look at, that'll be December 31st. Okay, so let's just go ahead now and let's just focus in on transactions. Okay, I keep saying that, but that's what we're going to do here now. Okay, so we go ahead and we have the purchase of sales or goods, or there's been money loaned between the U.S. company and a foreign entity. There's been a forward contract, purchase of the actual currency units, etc. Okay, we're going to kind of stay up here for the most part. Okay, and that we're talking about transactions like what I described, purchasing some inventory from, say, a Mexican company, something like that. Okay, now when we do this, we will have the transactions that will be denominated in a foreign currency, and then we're going to have to go ahead and turn those over to the reporting company's currency, which for our purposes will always be the US dollar. Okay, and so we can go ahead and see how we will generate a transaction gain or loss as a result of basically changing over from the foreign currency to the US dollar. And then as those exchange rates fluctuate, we'll see that there will be gains and losses that will be generated. Okay, and those gains and losses will be, of course, reported on the income statement. So when we take a look, we'll have our transaction date, we'll have our balance sheet date, and then we will have an ultimate settlement date. And each of those will, there'll be variations, fluctuations in the exchange rates between these different dates. And these fluctuations between these dates, the balance sheet date, let me go ahead and circle it, the transaction date, the balance sheet date, and the settlement date will all generate foreign currency transaction gains and losses. They will simply be reported on the income statement. Okay. All right. So again, we're going to be dealing with transactions first, and then we'll deal with the remeasurements, etc., or translations that happen when we're going to consolidate. But foreign currency transaction gain or losses occur when a company buys from a seller to a foreign company with whom it has no ownership interest and agrees to pay or accept payment in the foreign currency. Okay, transactions between a permanent and a permanent financing nature are not considered foreign currency transactions. So again, we're dealing with unrelated entities that are going to have foreign currency transactions. Okay, and so we're going to be importing, exporting goods, borrowing, lending, investing, etc. Okay, now there will be changes in the exchange rate, and that change in the exchange rate is what happens when there's the change between the time of purchase and the time that we finally settle, actually pay that. Okay, and if there's a transaction not settled at the balance sheet date, then there will also be a gain or loss that is recognized in current net income as we go ahead and compare the exchange rates at the date of the balance sheet versus the date of the transaction. Okay, so let's just take a look here, and I think we see a lot of words there, and then when we look at this example, we're like, okay, that's it. It's pretty straightforward. Okay, so what happens? We go ahead and we purchase 10,000 units, or not 10,000 units, it doesn't say how many units, but it's 100,000 pesos is the cost of these items we're purchasing. Say it be those Mexican cookies that I was talking about. Okay, and so what happens for our purchases or our inventory, assuming we were on a perpetual system, but the debit is going to go to either purchases or inventory, and we're going to go ahead and take the 100,000 and we multiply that by the exchange rate at the date of the transaction, December 1st, and we turn that from pesos into dollars. We set up the payable, we set up our inventory, we set up our purchases. I guess we were using periodic method. Then we go ahead and we look at 12/31. Remember, we set at the balance sheet date. We have to sit there and compare whatever the exchange rate was at the date of transaction, the balance sheet date, usually December 31st, to see if there has been a fluctuation, which there almost always will be, and and see if that generates a foreign exchange transaction gain or loss. Now, since the rates were sitting there at 0.1, the exchange rate was 0.1 peso to the dollar at the date of the transaction. Now we look, and at 12/31, hey, exchange rates have moved in our favor. we only, if we're the U.S. company, the Mexican companies moved against them, but we're assuming that we're the U.S. company here, it's moved in our favor, and that now we only have to give up 8 cents to acquire a peso. Okay, so that means that there's been a 2-cent fluctuation. Okay, and you would simply do that. You would take the difference between the rate at the date of the transaction and the rate at the balance sheet date, if we haven't settled that yet by year end, obviously, and that results in a 2-cent difference in our favor. And so we would go ahead and multiply the number of foreign currency units, in this case 100,000 pesos, times that fluctuation, and that results in a foreign exchange. In this case, it's a gain because the rates moved in our favor, and of course we don't owe as much in dollars anymore since we've been fortunate enough to have the transaction or the exchange rates move in our favor. So we would reduce the accounts payable by debiting it by the fluctuation. Okay, so that's pretty easy. And then we finally settle this thing on February 2nd. And by February 2nd, we look and the rates have moved a little bit against us from the balance sheet date at the end of year one to when we ultimately settle that, the settlement date, at February 1st, year 2. So they've moved 1 cent against us. They went from, now we have to give up 9 cents instead of 8 cents. And so we would go ahead and take that fluctuation, multiply that by the number of foreign currency units, in this case 100,000 peso. That's going to be a 1 cent fluctuation to our detriment. So that results in a foreign currency transaction loss. So we pay them in dollars, or we pay them in pesos, but that's to acquire those pesos, we would have to give up $9,000. So we credit cash $9,000, and then we go ahead and liquidate the accounts payable that we had set up for $8,000, and we take the loss. Okay, so you'll see, we'll look at a couple. I'm not sure that I'm going to go through every single one of the questions in the quiz, but you'll see the quiz there. And then when you take the actual, the practice midterm, whatever, and then when you take the actual practice final, and then when you take the actual final, then you'll see that there are a fair number of questions that just contemplate your understanding of this. Okay. So that gives us a chance now to move into the discussion of how we would handle a foreign currency situation now where we have a foreign subsidiary and we are simply trying to include that foreign subsidiary's information into the U.S. parent. Will have to turn that foreign entity's financial reports into from the foreign currency to U.S. dollars. And so we'll take a look at that here in a couple seconds. Okay, I'm going to go ahead and hit pause for a second, and then we'll pick this back up here. And for you, it'll be absolutely no change in time because I'm going to hit play again, but for me, there's going to be a few minutes pause here. Okay, guys, so let's go ahead and first let me make sure that I've got audio here because that would upset me very much if I went through this whole presentation with you and I did not have the audio I want. So checking. Okay, good. I've got audio. Okay, so let me go ahead and let's wrap this up now for this chapter 11. And we're also going to talk, by the way, I've been talking about foreign currency. We're also going to talk about segment reporting here in this chapter as well. But let's wrap up at least the foreign currency discussion. So taking a look at some terminology, okay? And again, where we are now is we're going to assume that we have a U.S. company foreign subsidiaries' financial statements are going to be denominated in some other currency, say the pound. I'm going to use a U.S. parent English subsidiary as an example. Say the pound, and we are going to want to have to turn the pounds into dollars, so that then we can follow the process that we've been learning in some of the earlier chapters of consolidating that now foreign subsidiary into the U.S. parent. Okay, now we have already understood that the current exchange rate from our discussion of foreign currency transactions is simply going to be the exchange rate at the balance sheet date. Okay, sometimes they'll refer to it as a spot rate. It is simply the spot rate at December 31st. Sometimes we'll see a spot rate in our transaction discussion as the rate at the date of the transaction. But for our purposes here, we're going to be really seeing that the spot rate is the current rate, which is the December 31st balance sheet date. Okay, for our purposes. Okay, historical exchange rate is the rate that was in effect at the date of a particular transaction, say the date that we acquired some equipment, whatever. Okay, now the weighted average rate, okay, or the average weight, okay, and you'll see that in some of the problems. And if we have transactions that have occurred evenly throughout the period, then we'll use the average. Okay, for example, sales pretty much occur evenly throughout the year. So for our sales, we will frequently use the weighted average or the average rate. Now, it gets a little bit confusing sometimes when we talk about inventory, because in some questions we'll see that they acquired the inventory at a particular date and they just use the historical rate for a balance sheet item like inventory, non-monetary balance sheet item like inventory. They will simply use the date of the transaction. But in some questions you'll see it contemplated that the inventory was acquired evenly throughout the year, in which case you'd use weighted average. So for income statement accounts, weighted average is used, or averaged is used quite a bit. For some of our for our balance sheet, we'll often use the current rate, the historical rate, depending on whether that asset is monetary or non-monetary. But for a few assets like inventory that might be acquired evenly throughout the year, then we would use the weighted average. And you'll see when we look at that in some of the questions that that's pretty easy, although it may seem a little confusing right now. Okay, and then we take a look at the reporting currency, and the reporting currency for our purposes will always be the US dollar. Let me get my colors right. Okay, always US dollar for our purposes. We will always assume and the reporting currency is the currency of the parent, will always assume a US parent. Therefore, we will always assume that the US dollar, okay, is always, that's US, not VS. US dollar is always the reporting currency. Okay, so let's just go ahead and continue on here now with our terminology. And you can see that, let's just put this into slideshow mode, okay? We've got this terminology, functional currency. Functional currency is the currency in which most of the economic activity takes place. We're considering that the functional currency. Now, we will either use foreign currency translation or foreign currency remeasurement, depending on the nature of the business activity of the subsidiary and the parent. And I'm going to give you an example here in a couple seconds, rather than try to understand from these words that are here. I'm going to give you an example, and then we'll kind of put it back into words that you may see in some questions that will help you understand whether you should use translation or remeasurement. And we'll also have a third scenario where you may have to use both of these, and you'll see how that works here in a couple seconds. Okay, Then we have these definitions down here: monetary versus non-monetary items. Okay, monetary items are fixed, denominated in dollars, regardless of changes in specific prices. Okay, for example, cash. Okay, is the classic example of monetary item. You have $10,000 in your pocket. You fall asleep for 5 years, you wake up 5 years later, Rip Van Winkle, whatever, 100 years later, and there's still $10,000 in your pocket. Now, it may not buy as much, but it's still $10,000. It doesn't become $100,000 or something just because it's, time has passed. So cash is an example of a monetary item. $10,000 stays $10,000. Its purchasing power may change, but its amount, what it's denominated in dollars, stays the same. Okay, monetary items will fluctuate in value. Classic example is, say, a house. You buy a house back in 1990. That house is going to be much more expensive now than it was back in 1990. Maybe 1990 you bought it for $200,000. Now let's say that same house is worth over $1 million or something. So what happened? The price fluctuated significantly between 1990 and the current time. Okay, so that's examples, classic examples of monetary versus non-monetary items. And the reason it's important is because depending on whether we're using translation or remeasurement method, we will have to know what exchange rates we should use. And again, we don't have to memorize exchange rates between, say, the pound and the dollar, but we have to know whether we should use the current rate, the historical rate, the weighted average rate, some of those terms that we saw on the last slide. Okay, so let's just go ahead and just in case you need a little review of examples of monetary versus non-monetary. Cash is classic examples, I said, of monetary, but also what? Accounts receivable. Someone owes you $10,000, change in price level, they still owe you $10,000. Okay, inventory. And you need to be careful because I think that sometimes students get a little confused and cross wires on current assets versus non-current, and potentially current assets being monetary, non-current being non-monetary, and that's not how it works. It does the value of that item fluctuate with changes in the price levels, right? So if you have a bunch of inventory sitting in your shelf at the beginning of the year, by the end of the year, that inventory could go up or down or value as time passes. Okay, probably down in value. That's why companies don't want to stock up, especially these days. Companies don't stock up on a bunch of inventory because they know that there's going to be some risk associated with that. The inventory being non-monetary, the prices will fluctuate with changes in the general price level. So, sometimes it's annoying. You go to the store, they don't have anything you need on the shelves because they don't want to carry that in part because of the risk that there'll be shift in price levels, and then they would have inventory that has probably gone down in value. Okay, so inventory is non-monetary. There's our property, plant, and equipment. That's like our house example. Liabilities, okay, accounts and notes payable, monetary, okay. And then for the preferred stock, common stock, our stockholders' equities, we call out whether it's monetary or non-monetary, but we're going to see that the foreign currency translation remeasurement rules are going to be very specific about what we should be using for our equity items, so we don't need to really worry about categorizing them as monetary or non-monetary for that purpose. Okay, all right, so what I want to do here is go through an example with you, and we're going to first go through the example, and then we're going to see how the example will relate to this particular slide, in which we're going to go ahead and put it into some words that you may see in some questions. Okay, so let's say, and we're going to do 3 scenarios here. Okay, and so let me go ahead and turn this to pen. So Scenario 1 is going to be that we have a U.S. parent with English subsidiary. I'm just going to put English sub. Yeah, this pen's going to mess with me. English sub doing most business in the U.S. I don't know why that pen keeps doing that. It's very annoying. If you think it's annoying for you, I have to keep erasing that and rewriting it. It's also annoying for me. Okay, U.S. parent with English sub doing most of its business in the U.S. Probably what you have is the parent was maybe doing business with this English company, and this English company was a major supplier to the U.S. parent. And so the U.S. parent just decided to acquire this English company so that they can control the flow of whatever. Maybe they're getting some materials or something from this English sub. So they just from this English company. So they just decided to acquire it. Okay. Now, if that's the case, okay, the English pound or sterling or whatever they call that, the English currency, is considered the local currency. Come on, pen, stop doing that. Is considered the local currency. US dollar would equal the functional. Remember, we said functional currency is where you do most of your business, and since they're doing most of their business with the US parent, really? Okay. Is the functional currency and it is always the reporting currency. So when we have a situation like that, we will remeasure. We'll use the remeasurement method. And that remeasurement method, when we see that, that signals to us what exchange rates we should use for our different items on our financial statements, our income statement, our balance sheet. Okay, so functional currency is where you do most of your business. You've got a U.S. parent with English sub doing most of its business in the U.S. U.S. is obviously the functional currency, and it's always the reporting currency. For our purposes, the English pound, whatever, the English currency would be the local currency. Okay? Okay, good. Now you come over, and we've got scenario 2. I'll put it right here. Why does it do that? Stop. Okay, and with scenario 2 now, we've got, again, U.S. parent with English sub doing most of its business in England. Okay, so what's happened now? Well, now probably, okay, you've got the U.S. parent who really had limited involvement with this English company. It was doing most of its business in England, let's say, minding its own business. And the U.S. parent looked and said, that looks like a nice investment for us. So they went and acquired the stock of that English company, and now they have enough where they're going to be consolidating them in. Let's say they bought 100% of the stock, right? So what happens? We have to turn the pounds into dollars, of course, just as we did in scenario one. But the nature of the business is a little bit different. Okay, so if that's the case now, the English currency, I'd pay like $50 right now to get this to stop doing that. The English currency is the local slash functional currency. Okay, the English currency, the pound, the sterling, whatever, is the local slash functional currency. US dollar, in every case, in every scenario, US dollar will equal the reporting currency. Okay, so what's going to happen here? If that's the case, now we will use translation method. By the way, guys, don't worry about trying to write this down on some note, and I apologize if you're trying to read this. I have another slide that I'm going to give you that I'll post up on iLearn that will summarize these examples, these scenarios, and also post while you're seeing this video, so you have the video. But don't worry about trying to write it down somewhere else. I'm going to give you some slides that will summarize this. Okay, but here we have the reporting currency is always the US dollar. The English currency is the local slash functional currency. And when that's the case, then we would use the translation method. Okay, and that again is going to signal to us which exchange rates essentially we should use. Should we use the current, the historical, and it's going to vary depending on which financial statement item we're talking about. We're going to see that coming up here on the next slide. Okay, all right, so now we're going to jump over to scenario 3. Okay, and in scenario 3 we're going to say it's our same two companies, let's say, but we're just changing up the scenario. US parent with between my spelling and the funkiness of this pen. English sub. And the English sub is doing most of its business in Greater Europe. Okay, so now the local currency, stop. Anybody knows why my pen is doing that, send me an email, will you, please, and tell me how to make it stop. Local currency equals the English currency okay. The euro will equal the functional currency okay. And for our purposes, what? US dollar is always the reporting currency. We're going to always assume a US parent. Okay, so 3 scenarios. Oh, I better tell you what we need to do here in scenario 3. And so in scenario 3, I'm just going to kind of put it over here where I have some space. For scenario 3, we will first remeasure oh boy, this is annoying. We will first remeasure from local to functional. Which is what we did up here. We remeasured from the local currency to the functional currency. And we stopped there because when the US dollar was the functional currency. Here, we have to first remeasure from local the pound to the euro, but we're still not to the dollar. So then as we go from the functional to the reporting, which is where we kind of were at this stage, we would then translate. And again, whether we decide, when we're using remeasurement versus translation, that just tells us which exchange rates we need to use to achieve these processes here. Okay, so we would first remeasure from the pound to the euro, from the local to the functional, and then from the functional to the reporting, which is always going to be the US dollar for our purposes. Okay, so then translate to reporting, which again is always going to be the dollar. Okay, now that's sort of the example that you could keep in the back of your head, and I'm going to give you a slide that'll summarize that for you here in a couple seconds. Not a couple seconds, but a little bit later, actually towards the end of this discussion, I'll give you that, and you can take a look at that. And I'm going to suggest that you have the summary slide that I'm going to post up on iLearn in front of you if you haven't taken your exam yet, in front of you while you're taking the exam. Okay, now what this slide does, and thank God we're done with all that writing on the computer because it's not the best thing in the world. What this slide does now is put sort of the example into more general language for us. Okay, and you can see, hey, this is when you remeasure, this is when you translate, this is when you first remeasure and then translate. Okay, but let's just go ahead. Okay, situation one, parent company is the reporting currency, the US, and the US currency, the dollar, is also the functional currency. Okay, and they tell us the reporting currency is the functional currency. We must use the remeasurement method, and it is to be used if the foreign subsidiary is highly integrated with the parent and serves primarily as a sales outlet for the parent. Day-to-day operations of the subsidiary depend on the reporting currency. And that was a situation that we described. English sub, U.S. parent doing most of its business in the U.S. Now, just as a side, I don't get too much into this in your questions, okay? But if we're in a highly inflationary economy, then they automatically tell us to use the remeasurement method, okay? But don't worry about that. Usually it's going to be described in the terms here. Functional currency equals the reporting currency, remeasure from the local currency, the pound in our little example, English currency, to the functional / reporting currency, US dollar in our little example. Okay, translation method, and we use translation method. Okay, got to use translation method. Okay, when the foreign currency, okay, the local currency, the foreign currency is the functional currency. Now, English company doing most of its business in England, so its functional currency is the local currency, the pound, and then we're going to translate from the functional / local currency to the reporting currency, always the US dollar. So now the foreign subsidiary is relatively self-contained and independent and operates primarily in local markets. Day-to-day operations do not depend on the reporting currency, okay? And so we'll use translation method. Now, notice over here, we have the situation when the functional currency of the subsidiary differs from both the subsidiary's local currency, the pound in our little example, and the reporting currency. Okay, so we have now done what? We've introduced another currency here now, the euro, let's say. So the subsidiary's financial statements must be remeasured from the local currency, the pound in our little example, to the functional currency, the euro in our little example, and then we translate from the functional currency, now the euro, to the reporting currency, always the US dollar. For our purposes. Okay, all right, so that puts it in more general terms, but I think it helps to kind of have this little example in the back of your mind too. Okay, all right, now once we understand which methods we're going to use, remeasurement method, very important, guys. Sometimes you will see information that will call that out as the temporal method. Okay, remeasurement method, temporal method. And the way we will affect that remeasurement, the exchange rates that we'll use for our balance sheet items, and this is why it's important to know monetary versus non-monetary items. For the monetary items, use the current, and it will be the year-end rate for our purposes, December 31st rate. For our monetary items, our cash, our receivable, our payables. For our non-monetary items, we will use the historical rate for our property, plant, and equipment, our inventory, etc. Okay? Now, you take a look at our income statement items, okay? And if it's a non-balance sheet related item, sales, salary expense, those sort of things, use weighted average. Okay, if we're dealing with our balance sheet related items, for example, cost of goods sold, if we're dealing with depreciation, okay, then we should go ahead and use the historical rate. Now, I'm going to show you that there could be a situation in which we would have to use the average for our cost of goods sold, for our inventory, and that's if they tell us that the inventory was acquired evenly throughout the year, then we would switch over to weighted average. And you have to read the question, okay? Now, we will have a remeasurement gain or loss that is reported on the income statement, and we're going to see that remeasurement gain or loss is literally going to be the number that we will need to plug into the income statement to get the balance sheet to balance. Okay, now we're not going to have to actually do this in a full setting here, in a full-blown problem, but I'm going to show you an example of that process a little bit so that you can kind of understand how that plug would work. But it's a plug that goes to the income statement just to make the retained earnings balance correctly on the balance sheet. And I'll show you how that works here in a little while. Okay? All right, good. Now, we could have to use the translation method. Again, important that you know sort of the other name for these methods. Translation method could also be referred to as the current method, okay? And if it's referred to as the current method, you need to know that means the translation method, okay? So let's just go ahead and turn that to highlighter and take it off of red, okay? Okay, so make sure you realize translation method could also be referred to as the current method. Now, if that's the case, again, the foreign local currency is the functional currency, most of the business being done in England, English company. For income statement items, we will always use the weighted average. Okay, we will transfer our net income to retained earnings, just like you would in any situation. Net income goes down to retained earnings. For our assets, okay, current year. For our liabilities, current year. For common stock and APIC, again, notice here we're not calling them out as monetary and non-monetary. We just use what? Historical rate. We will then roll down our net income to our retained earnings. So retained earnings is beginning balance plus the net income minus any dividends gives you the ending balance. And when we're done with that, the balance sheet won't balance. And so we will plug a number into the balance sheet to make the balance sheet balance. And that number will be our foreign currency translation gain or loss. And that is considered part of our other comprehensive income. Okay, so it's going to be contained in that part of our stockholders' equity, our other comprehensive income. Okay, all right, so let's just go ahead and let's take a look at this example. Okay, and we're going to consider basically the remeasurement method, the translation method separately. We're not going to have the situation where we introduce a third currency in this example. Okay, so we're just going to show you, this is more mechanically how you would affect the translation, the remeasurement, depending on the scenario that's described. Okay, so let's take a look at the process here as to how we might do this translation versus remeasurement, and they give us the different exchange rates. Okay, so we have the situation at December 31st, year one, and we have the different rates that were in effect for different periods, the December 31st to March 31st, April to June, July to September, October to December. Notice they're giving us quarterly rates here, contemplating that an entity might go ahead and have some sort of quarterly reporting that they're doing that would make these quarterly rates relevant to those quarterly reports. They give us the weighted average, okay, and then they tell us that the inventory was acquired evenly throughout the year. Now that's going to be important because remember, even though they told us for our non-monetary items we would be using our historical rate, if we're talking about the non-monetary item like inventory being acquired evenly throughout the year, then we would use the weighted average rate, and we would use that weighted average rate also for our cost of goods sold on the income statement. Okay, and then fixed assets acquired by the subsidiary were acquired at December 31st, year one. Okay, all right, so that would be the historical rate for those. So let's just take a look at this example, and you should be able to see it on your screen pretty easily here, the little watermarks. Okay, and so these watermarks are going to tell us what we should do first versus second. Okay, so when we sit here and we're talking about the remeasurement method. Okay, let's start with that one. Okay, remeasurement method. We've got what? We've got a foreign subsidiary, the English company doing most of its business in the U.S. We're going to use the remeasurement method. That means we're going to do what? That means we're going to use various items for our financial statements. Let's just go back and look here under the remeasurement method. Balance sheet, if it's a monetary, use the current rate. Non-monetary, use historical rate. But then we have to be careful that if, even though it may be non-monetary, if it's acquired evenly throughout the year, like inventory, we're going to be using the weighted average. Okay, but for other items like that equipment, we'll use the historical rate. Okay, and so you can see that. So here's the rates, right? There's our year-end rate is the current rate, right? So we'll be using those for the remeasurement using the current rate, okay, weighted average for our income statement items. However, if items are acquired evenly throughout the year, right here, then we're going to be using the weighted average, and then we will use the historical rate for our non-monetary items. So let's see if that's what we did. And so you take a look, and sure enough, and we start, that one means that we start with the balance sheet. Okay, so we go ahead and we remeasure the balance sheet, and when we remeasure the balance sheet, okay, let's just take a look. We take the item denominated in the foreign currency, whatever it is. We multiply it by, and since it's cash is a classic example of a monetary item, we multiply that times the current exchange rate, the year-end rate. Poof, we turn whatever this foreign currency is into dollars. Accounts receivable is a non-monetary item, so we go is a monetary item, a monetary item. So we go ahead and we convert that from whatever this foreign currency is to dollars. Now you look at inventory and you say, wait a minute, John, inventory, you said non-monetary, we should be using the historical rate. The historical rate was 0.18. What are we doing? Okay, well, they tell us that the inventory was acquired evenly throughout the year. If that's the case, then the exception for this particular non-monetary item is that you should use the weighted average. Okay, so we go ahead and we use the weighted average. You'll see other problems on your exam, etc., in which they say the inventory was acquired at a specific date, and then they sold that item, they sold those inventory items. In that case, then for inventory, you would use a historical rate. Okay, and then you continue on with your other monetary, before I do that, notice for our fixed assets, we're using what? Fixed assets, we're using the historical rate to remeasure those. All right, the 0.18 rate. Okay, and then when we get to our accounts payable, our monetary item, monetary liability, okay, year end. And then they told us for things like common stock, etc., you are simply going to use the historical rate. Okay, good. Then what? Then we would look at the retained, we would basically add in the beginning balance of the retained earnings, okay? And then you look and you see that we add up, well, we already see that up here our assets are 40,800, and the balance sheet has to balance, okay? So the total of the liabilities plus the stockholders' equity has to equal 40,800. But if you sit here and you add these numbers up, they do not add up to 40,800. So the balance sheet won't balance here unless we plug in a number to bring down, in this case, the total stockholders' equity to get it so that it will balance. And so we basically plug in this number here, this, sorry guys, this is a little confusing. I'm showing you in the wrong part. I apologize. We're over here now. Okay, we're dealing with the remeasurement. So we're over here. But same point, you add up these items right here, our liabilities, okay, and our common stock. And the balance sheet won't balance. And the balance sheet has to balance to what? Has to balance to this. Guys, we're over here, okay? I apologize for having been pointing over here all this time. When we do our remeasurement, we go from here, we multiply times 0.1, and that brings us over here, okay? And we're doing that for all of these balance sheet items that I've been talking about using the appropriate rates, okay? I just apologize, that's a little confusing. But when we do all of that remeasurement, okay, we're sitting here and the total is the 63,653, okay? The balance sheet has to balance, but if we added these numbers up right here, the balance sheet would not balance, okay? So in order to make the balance sheet balance, we plug in a number, and when we plug in that number makes the balance sheet balance. So we're basically adding that number to retained earnings, okay? Well, what do you add to retained earnings? Your net income. So now, and following our watermarks of 1 and 2, we go ahead and we simply declare that 11,053 is our net income, because we added it to the retained earnings in order to get the balance sheet to balance. Because when we did our remeasurement process, remeasured our assets, remeasured our liabilities using the appropriate rates, and again, I apologize, we were in this column as we had used those rates to remeasure those, then we had a balance sheet that didn't balance. Balance sheet got a balance. We learned that in Accounting 100. And so what happens? We have to now plug a number in there to get the balance sheet to balance, and that number, we consider that to be the add to retained earnings. We consider that to be net income. Now we go ahead, and thus the watermark 2 there that you can see. Now we go ahead and we remeasure the income statement items. And for income statement items, if it was not a balance sheet related item, we simply use the weighted average. Okay, so we use that for sales. If it was a balance sheet related item, but the balance sheet related item was acquired evenly throughout the year, and that's usually the case for inventory, right? Or the inventory is going to be the exception, where for a balance sheet related item, we won't use a historical rate, we'll use the weighted average. But we go ahead, we remeasure that. For depreciation expense is a balance sheet related item, right? So for that, then we would go ahead and use the historical rate. And again, if you're saying, well, where did these rates come from again? Again, we got them from this slide, right? Okay. And so we go ahead, we remeasure all of our income statement items. And when we do, we end up with this number for our net income. The difference between our revenue minus expenses gives us what? Gives us an amount for net income, which would be $66,938 minus the total cost and expenses of $62,739. That's not $11,053. So what we do is we go ahead and we plug a number right here that will make the income statement work, so that the bottom line is what we've already plugged in there for our net income, which is $11,053. Okay, so you just plug numbers in there to make these financial statements work, right? You basically plug in your net income, and then you go ahead, you do your remeasurement. When you do your remeasurement, then you're going to have a difference between what the income statement is showing you as net income and what you ultimately reported had plugged in there as net income. And that difference now is our foreign currency exchange gain. And under the remeasurement method, okay, that number is going to be reported right there, 6854 on the income statement. That's that plug that we put in to make the income statement work appropriately. Okay. All right. So that is the remeasurement method. I'm going to go ahead and stop for a second. Okay. So for you, it will not be any time at all. I'm going to go ahead and stop for a second and then come back, and we will pick up with the translation method on this same slide. Okay. Okay, guys, so let's go ahead and let's wrap this part of the discussion up now. Looking at what happens now under the translation method. Okay, so now we're going to focus on that method for translation method. And again, translation method would be used if the local currency was the functional currency. We're going to translate from the functional / local currency, the pound, to the dollar, right? Now notice here the 1 and the 2, meaning that now we're going to sit here and start with the income statement, roll our retained earnings, our net income down to our retained earnings, and then we'll go ahead and translate the balance sheet. The balance sheet won't balance, and we'll plug in a number down in the equity section here that will be another comprehensive income number that we'll report as a foreign currency now translation gain or loss. Okay. Now the translation method, remember guys, was also called what? The current method. And so it's pretty easy to remember. You almost always use the current rates. Okay, so you use the current rates and the weighted average on the income statement for everything. We just assume that everything sort of happens evenly throughout the years. Okay, and so it's pretty easy to know how to use this translation method, or remember what rates to use. Use the weighted average, okay, for all of my income statement items. Okay, when I do, I calculate net income the old-fashioned way, revenue minus expenses, gives me the net income. I then go ahead and we assume they just started business, beginning retained earnings. There's no dividends contemplated in this example. And so the amount of my net income becomes my balance in my retained earnings, which I plug down, of course. We say plug, I mean our retained earnings rolls down to our, our net income rolls down to our retained earnings, right? And then we go on the process using pretty much the current rate for everything except the common stock. Okay, we use the current rate, year-end rate for everything on the balance sheet. Okay, that's the second thing we do, the balance sheet second. We go ahead, we do all those. That then rolls up my total assets into 40,800, and then I go ahead and I translate my liabilities. Okay, and then common stock is the one that uses the historical rate. Okay, so I always use historical rates for common stock. That was the same under both methods. Okay, and that gives me then the amount for my liabilities, my common stock. I rolled my ending balance of retained earnings down to my retained earnings. And when I do, if I sat here and I added all this up, as I was saying earlier when I was in the wrong column, the balance sheet wouldn't balance. Okay, so to make the balance sheet balance, I simply plug this number in. I plug a number into the accumulated other comprehensive income that makes the balance sheet balance. And when I do, now the balance sheet balances, the accounting gods are happy, and I have completed my translation from the local slash functional currency into always the reporting currency on the for our purposes the US dollar. Okay, all right, and then again, remember, if we had 3 countries, then we would have first had to remeasure from, say, the pound to the euro, and then from if the euro was the functional currency, then from the functional currency we would translate to the US dollar, which is our reporting currency always. Okay, so what I want to do now, show you a couple of summary sheets here. Okay, this is helpful. Okay, and yeah, this is pretty helpful. I like this. Okay, but then before we get into segment reporting, and what I'm going to do actually is post this lecture up as part 1, so that I get this up there, and it's going to be available sooner rather than later, and then I'll put up segment reporting a little bit later. Okay, but what I want to do before to have that all part of this video is show you this. Okay, I'm going to post this up on iLearn. Okay, and what I like about this is it sort of has some of the information that was on that previous slide, where there was a summary slide there, but now what I've done here is I have gone ahead and tied it back to our little example. U.S. company with English sub, doing most business in the U.S. If that's the case, you use the remeasurement method. U.S. company with English sub, doing most of its business in the U.K. If that's the case, then we translate. Okay, and I say U.S. is always the reporting currency on the exam for our exam purposes and stuff. That'll be the case. Okay. All right. Good. Now notice I give you the rates that you should use under the two scenarios down here. Okay, which we saw in that other summary slide, but I like this one because it relates back to our little example. Okay, so the rates to use for the balance sheet, for the income statement, etc. Okay, and the only thing that might get a little confusing is we say for non-monetary use the historical rates, but be careful, inventory could be weighted average if they tell you the inventory was acquired evenly throughout the year. And for our income statement items, if it's a balance sheet item, related item like depreciation, cost of goods sold, we should use historical. But again, be careful if we're sitting there and we're telling you that the inventory was acquired evenly throughout the year, then the cost of goods sold, and that uses the weighted average, and the cost of goods sold should also use the weighted average. Okay. What do I want to do here now is go and look at a couple questions. Okay, so let's just see how we would answer some of these. Okay, let's take a look at this first one. Under U.S. GAAP, in preparing consolidated financial statements of a U.S. company with a foreign subsidiary, the foreign subsidiary's functional currency is the currency, as we've learned, in which they do most of their business, right? Okay, so that's the green is the correct answer there, where you do most of your business. Okay, the environment in which the subsidiary primarily generates and expends cash. So when we were doing most of our business in the U.S. dollar was the functional and the reporting currency. When we were sitting there and using the translation method, then we had what? We had the English sub doing most of its business in England. English was the English pound was the local / functional currency. Okay, good. When remeasuring foreign currency financial statements into functional currency, which of the following items would be remeasured at historical cost? And you look, and you have what? You have your securities, your bond payable, your accrued liabilities. And remember, inventories are going to be measured at marketable equity securities. By the way, guys, be careful, not our securities, but securities we've acquired of other entities, right? Our liabilities, our assets, we're going to use what? We're going to only use historical costs for inventory. But be careful, if it says something like the inventory was acquired evenly throughout the year, we should use weighted average. Okay? All right, so that gives us some of the rules that we learned there earlier. Okay, remember that we also will have transactions, okay, that we'll want to take a look at. Foreign currency transactions was also something we discussed there, so let's just look at it right here. On September 1st, year one, Cano Company, U.S. Corporation, sold merchandise to a foreign firm for 250 pesos. Terms of the sale require payment February 1st of year two. On September 1st, year one, the spot rate was 0.2. That's when we basically had the transaction. At December 31st, the year-end rate was 0.19, but the rate had increased to 0.22 by February of year two when the payment was received. How much did Cano report as a foreign exchange gain in year two? Now here they gave us that as a gain. Some questions you'll see they won't tell us. They say gain or loss. Okay, good. So we have to know, how to figure out if it's a gain or loss, right? And so what happens is the exchange rates moved in our favor here, Cano's favor, and that what? They were $0.19 to the peso, but now the rate has increased to $0.22. So we're going to get basically more dollars from this transaction. So that's going to result in a gain. And then it's important to note that we use the February 2nd date or February 1st year two date because they're asking me what is the gain or loss reported in year two. So I simply would take the amount at the settlement date versus the year end rate, that's a 3-cent difference, times those 250,000 pesos. So we're going to be getting $7,500 more out of that transaction. That's considered a foreign currency transaction gain. Now here we're not dealing with remeasurement versus translation or anything. We're just simply dealing with the transaction that's reported on the income statement. Okay, so you can look at the rest of these questions. I'm going to go ahead and stop right there with this part of the lecture, and I'm going to put the next part, segment reporting, up as a separate file so I can get this loaded up for you and you can start to take a look at this part of the lecture, which you've now looked at, and stay tuned for part 2, which I'll be posting up on iLearn. Okay guys, thanks.